Welcome to HyperProfit. I'm Andru Edwards, and while none of this is financial advice today, I need to talk to you about why stock price doesn't matter when considering which companies you want to invest in. I know that sounds pretty crazy, but I'll explain. This video is going to be addressing a couple of recent comments about how to get started with investing if you have a limited budget when the best companies have really high stock prices. I'm also working on my next stock deep dive, so be sure to hit subscribe so you don't miss that one when it drops. And shout out, by the way, to the 21% of you who have also hit the bell icon. Notification squad in full effect here on HyperProfit. Okay, before we jump in, hit me in the comments below and let me know if you signed up for Webull yet so that you can get an extra 8.5 hours of trading time per day, since it gives you access to the pre-market and aftermarket. If you haven't, I've got a link down in the description below for you. Also, if you missed my last video where I talk about the big opportunity that I see in Zillow, you have to watch it. I think a lot of people slept on it because Zillow isn't seen as a tech or biotech or green energy company, but there's tremendous upside to them that I explained in the video, so I will leave that here for you to check out as well. Now let's go over how my portfolio is doing today, and then we'll jump into why stock price doesn't matter. Okay, pulling up the portfolio that I use for videos here. As you can see, for the day, I am up 5.04%. For the past week, I'm up 2.71%. For the past month, I'm down 7.11%. For the past 3 months, up 13.52%. For the past year, I'm up 26.63%. And then all time, I'm up 27.1%. Now, remember, I did take a bunch of profits last week and then reinvested back into the market on the dip. So that changed a lot of these numbers fairly substantially if you compare them to videos from even just 2 weeks ago. And I did also explain why that is in the last video as well. Okay, so like I said at the beginning, and like you saw in the title of this video, stock price doesn't matter. This is a message for the new people who are just getting into investing, sort of an investing for beginners tip, if you will. So let me show you a couple of recent comments and then I'll explain. Here's a comment from a friend of mine, Mike Bitter. He asks, are you going to be doing a video soon geared towards anyone who wants to get in the game with an investment as small as $500 to $1,000? I have a few friends who I put onto this channel, thank you, Mike, and they love it, but a stock like Roku isn't exactly affordable. Otherwise, keep up the great work, King. I jumped in on some things you recommended and I'm hyped. Now, first, I love how we're all calling each other king and queen on social media these days. We're out here building each other up and I am here for it. Second, he was referring to a video I did where I talked about how Roku stock is an incredible buy for long-term investing. If you didn't see that deep dive, I'll leave a link down under the like button for you. So feel free to smash that on the way down there. But before I answer Mike's question, one more comment I want to read. This one is from HyperProfit subscriber John Mirza, and it was in regards to fractional shares. He said, but fractional shares give fractional profits. We like playing with fire and making more money quicker to pay on college loans. I'm speaking for a large number of people I know, including myself, who are into that. Okay, so both of these gentlemen were basically asking me to recommend good stocks that have cheaper stock prices so that they can buy into them. And I wanted to explain why that's the wrong question. You see, fractional shares is still fairly new to most people. I think Robinhood only added the fractional feature about a year ago for the masses. Before this, you had to buy a full share of a company if you wanted to invest in them. So if you really believe that, say, Amazon was the wave of the future, you'd need over $3,000 to get in because you'd have to buy it in full shares. That kept it out of reach for so many people. New investors, people testing the waters, people trying to learn, teenagers who want to get into investing, etc. However, today the game has changed. You can take any amount of money, $1 or more, and invest it into just about any company on the market with very few exceptions. This means that today, if you only have $100 and want to invest in Amazon, you can do that and get about 3% of one share. Now, to address John's comment that fractional shares equal fractional profits, this is actually the wrong way to look at it. What you want to look at is the percentage of return on your money, not the dollar amount. Just like I did earlier when I showed you my portfolio. You see, fractional shares give you the full percentage return on your money, and that's the important part. So let's look at 3 examples. Say you have $50 to invest in the stock market. First, you invest $50 into Apple, ticker symbol AAPL. Let's say Apple is a $100 stock. If Apple rises by 10% to $110, your money also rises by 10% to $55. So in this case, everyone who has invested in Apple, whether they own half of one share or 5,000 full shares, they all get 10% return on their money. Next, let's say Upwork is trading at $50. You have $50 and so you buy one full share. Is this better than buying half a share of Apple at $100? Well, if Upwork stock rises by 10%, you now have $55. That is the exact same amount as your fractional purchase from Apple if that rose by 10%. So no change whether your half a share of Apple rose by 10% or your full share of Upwork rose by 10%. You're still left with 55 in both scenarios. Now scenario 3, let's say Dropbox is trading at $25. So you take your 50 bucks and you buy 2 full shares and then Dropbox stock rises by 10%. Well, now it's at $27.50. Again, you own 2 shares, so that's $27.50 times 2, which again brings you to $55. So again, in all 3 scenarios, we invested that same $50 and we ended up with $55 when shares of that company rose by 10%, regardless of how many shares we have. The price of the company doesn't matter when you're buying in fractional shares. Instead, the percentage of movement in the stock price, that is what matters. In other words, if you want to get into investing and have a small budget, there's no reason that you can't buy into the largest companies in the world that you believe in. As they grow, your money will grow in lockstep. And of course, as they shrink, your money will shrink in lockstep too, which is why we look to invest in companies that we understand and believe in when going long term. So when I talk about companies like Fastly or Roku or Amazon, don't focus on the cost of a single share and instead decide if you think the company has growth potential. If it does, that's when you decide that it's a buy regardless of what your budget is. Now, if you have any questions about this or comments or rebuttals, drop them down in the comments below and I will meet you there for further discussion. Please don't forget to check out the video I did on Zillow a few days ago. I see tremendous potential there that I think a lot of people are sleeping on, and you do not want to be one of those people. I hope I've explained fully why fractional shares are a major game changer. The way the market works for retail individual investors like us today versus even 2 years ago is so different, and there's so much more opportunity now thanks to this one feature. Do not forget to hit the Webull link as well if you don't have an account yet so that you can get in the pre-market and aftermarket with us. That is where I make the vast majority of my gains. Until next time, thanks for watching as always, guys. I appreciate your support. I'm Andrew Evers, and I will catch you on the next episode of HyperProfit.